In this video, we will be discussing about the money market hedge, the three-step process in case of payable. Now, what is money market hedge? It is the process of hedging the foreign exchange risk, that is the foreign currency risk. Now, what happens whenever there is foreign currency payable? So I have a fear. Now, what is that fear? That the foreign currency price may rise. Now, for example, I am an Indian importer and I have imported goods from US. So in return, I will have to make payment, and this payment, say for example, I am required to make after 3 months. So there is fear that the price after 3 months of the dollar will rise, and due to this I will have to make a higher payment or a higher amount. So I have a fear. So I can eliminate this foreign currency rising risk in two ways. The first choice is to enter into a forward contract, and the another choice is to enter into the money market hedge. Now, what is this forward contract concept? It is entering into a contract, deciding a specified rate today, and the transaction will take place in future. So we are just going to lock the rate. Now, for example, the dollar payable is 2,50,000, that is 250,000 after 6 months, and the 6-month forward rate is 50/51. So I have payable, that means I have the fear of rise. So I want to hedge the same. I will buy this forward contract, and the amount or the outflow will be 127,50,000 Indian rupees. Now, the another option that is available with me is to use the concept of money market hedge. Now, this 2,50,000 or 250,000 is payable after 3 months. So rather than doing contract or transaction after 3 months, I am going to buy this foreign currency today. Now, this 2,50,000 is payable after 3 months. So what is the value of 2,50,000? That is, we are going to calculate the present value of this foreign currency payable. Now, there might be confusion sometimes relating to the interest rate to be used. So this interest rate will be the investing rate in the terms of dollar, that is the foreign currency. And then we are going to buy this spot, that is, we know that what is the present value of this payable amount, and then we will buy this, that is, we have foreign currency payable. And then after buying this spot, the money we require, that is the home currency. So what we are going to do, we are going to borrow that home currency. Now let's take this an example and make it more simple. Now, dollar payable is 250,000, spot rate is 48/49, and 6-month forward rate is 50/51. The 6-month interest rate is rupees 8% and 9%. They are already 6 months, so no need to divide and multiply further. Now there are 3 steps, that is, invest the foreign currency. Are we investing the foreign currency? No. What we are investing? We are investing the present value of the foreign currency. So first we are required to calculate the present value of dollar 250,000. Now what will be the interest rate? Interest rate, that is the deposit rate. Now deposit rate for the customer will be the rate at which the bank will buy. So 250 divided by the interest rate factor, that is 1 plus 3%, that is 250 divided by 1.03, that gives us $242,718. Now the second step is to buy this dollar spot. Now what is the spot rate? That is 14.49. I need to buy, that is the rate at which dealer will sell, that is 49. So the rate is also given of the dollar and this amount is dollars. So we will directly multiply. So now we require Indian rupees, that is 11,893,204. So this amount, we are not going to invest this amount out of our own funds. We are going to borrow this money. So the borrowing rate, now the borrowing rate, as you can see, is 9%. That is the rate at which the dealer will sell. Now this borrowing rate is the amount that we have used 6-month interest rate. That is, after 6 months, what will be the outflow? So this will be the outflow under the money market hedge. Now we know that is the payable, that is lower the better. So we will compare both the options, that is number 1 money market and number 2, that is the forward contract. So in money market we are required to pay this amount, that is 12,963,592 Indian rupees, and in foreign currency we were required to pay 12,750,000. So as you can see, the foreign currency we are paying less, so which we are going to prefer, that is the forward contract. So this money market hedge concept is used in hedging the foreign currency risk. So in payable there are 3 steps, that is invest, buy and borrow. Thank you.